today's webinar. My name is Rochelle Hardy-Neal. I'm the Chief Operating Officer of the FSC. And today we are having a webinar on the future of total permanent disability insurance. I would like to introduce our facilitator, Shaun Black, who will introduce the panel and take us through this topic today. Shaun.
Thanks very much, Rochelle, and welcome everyone. Thanks for joining today. I'm Shaun Black. Just a bit of background about myself. I've had about 25 years experience in the industry, probably for the last 15 years looking more at product management. Currently with the ASB Bank and the insurance team, and also chair the FSC Good Customer Outcomes and Product Sustainability Working Group. So today we'll be looking at some of the key findings that have come from the ALUCA, which is the Australasian Life Underwriting and Claims Association deep dive into TPD. And we'll discuss some of the key points that are also relevant to take across for the New Zealand market to consider. Now, to help go through this today, very fortunate to have over 60 years of combined experience across three excellent guest speakers, which I'll now introduce. So joining us today are Carly van den Akker, who is Head of Life and Health Claims, Swiss Re, Australia and New Zealand. Carly has 15 years experience in the insurance industry, joined Swiss Re in 2011, extensive experience across claims management and rehabilitation, that's in the UK and Australia, and recently completed her 6-year tenure on the ALUCA board. Next up is Scott Phillips, Business Manager for RGA for New Zealand branch. Scott's been in the industry for a wee while, 28 years, joined RGA in 2007, supporting RGA's New Zealand clients. Scott's also a serving member on the New Zealand Life and Disability Underwriting and Claims Assessors Association. And also from RGA, we have Carmel Twist. Carmel is Head of Underwriting for Australia and New Zealand. Again, a lot of experience, more than 20 years in underwriting, been with RGA since 2012. Carmel's also a current director of ALUCA and also a member of the CALI, which is the Council of Australian Life Insurers Underwriting and Claims Working Group. Look, and to kick things off, I was going to hand over to Carmel to run through it, but just to run through the findings of the ALUCA report. But I think just to kick off, it might be good just to talk about any of the key differences we see across or between the New Zealand and Australian market when it comes to TPD, just to set the scene a little bit. So I don't know whether Carly or Scott, you want to talk to any of the key differences in TPD across New Zealand and Australia?
I'm happy to kick it off from an Australian perspective. I think if we look at the size of the TPD product in our market, it's probably between sort of 15 and 20% of the retail market here, whereas in New Zealand, the TPD product takes a lot smaller chunk of the market, sort of 3 to 5% of the products sold are for TPD. And they're often sold as linked products, linked to IP or trauma or what have you. And I guess the other thing that we've had in Australia is the compulsory TPD through super in our group insurance space. So there's a lot more customer awareness around what TPD is, what lawyers do for TPD insurance. We went through a group insurance crisis in 2013-14, and just the knock-on effects of legislation changes and how that's impacted TPD. So a lot of that will shape what we talk about today around some lessons learned on TPD sustainability, but I think it sets a slightly different scene. And then the other critical thing is that in Australia, with the legislation that we have to operate within, we can't fund any medical treatment, including psychological services. And so that then limits our ability to try and rehabilitate people who lodge a TPD claim by funding treatment. So another thing sort of that's we're up against when we're managing TPD claims in Australia.
Yeah, and I guess from the New Zealand perspective, funnily enough, the words in the policy documents are almost identical. Yet due to the size, the fact that there are lots of linked covers, so we tend to, I guess, assess the benefits that are most readily available to the insured, that we probably haven't encountered as much TPD or complete disablement covers in New Zealand as they have in Australia. And I think the way it's sold and adjudicated here has been very much to the letter of the policy, which means it is very much catastrophe cover for people. In Australia, there's been slight differences of interpretation. There's been an overlay of geography. So not only is the person disabled to the point where they trigger the benefit, but geographically where they live, can they actually reasonably be expected to get a job in their usual or own occupation, which that's a fairly difficult test, and probably means why there's so many people living up in Byron Bay.
Thanks, Scott. Right, from here, Carmel, do we want to dive into some of those key findings from the Akker investigation?
As Shaun mentioned, I'm a director on the Australasian Life and Underwriting and Claims Association board, and I co-led the paper that was produced in Q4 last year on TPD. So I don't want to bore you too much with lots and lots of details. We did have a charter, and we called upon basically our 2,000 strong membership to record sort of the issues as we see them, problems, ways forward from the front line. And when I say front line, I'm talking product, I'm talking underwriting, claims, and medical. I did think that maybe I wouldn't spend too much time on a history lesson, but I did think some statistics and key differences would be worth touching on. So in Australia, around 13.4 million Australians have some form of TPD insurance, mostly through their superannuation, as Carly touched upon in her opening remarks. There are tens of thousands of claims, and I think, interestingly, the top 5 claims are mental health disorders, accidents, musculoskeletal disorders, and nervous systems, and then followed by cancer. And when you think about when TPD was first launched around the 1960s, it was when Australia had really labour-intensive industries. So, for example, mines and factories and farms, generally operating in sort of remote areas. And when you fast forward the clock 60 years, the workplace looks quite different. Those industries aren't as represented. They are represented, but now we're sort of looking at sort of construction and education and those kind of industries. And for many Australians and New Zealanders, the workplace is actually looking like home. A lot of us are working from home. So when we consider the name total and permanent disablement, and we consider the catastrophe cover that Scott talked about in one of his opening comments as well, I think, back in the 1960s and beyond, with these with less workplace health and safety in place and these overrepresented sort of sectors in the market, then that catastrophe cover, that accident workplace cover would have easily made a lot more sense in a catastrophic way, and now things have changed, and maybe perhaps the product hasn't moved on with it. We'll explore that today, and we'll talk about those challenges. I just talked about how we reached out to our members. We got lots and lots of responses, and there was a charter. This was not to agree on any industry or operational practices. This was just to share our thoughts. It's called a white paper, not a best practice paper. So I'm going to start with products. I'm going to talk about the 5 key challenges in each area, as well as suggested paths forward. The product group listed their top 5 as subjectivity and difficulty determining the permanency of a condition. Like I said before, for real catastrophic accidents and for people who will never work again, that seems a lot easier than for conditions that are harder to measure. And I think it's important when we talk about subjectivity, there are things that may not have a very clear objective measurement like other physical conditions. So they have snuck into this into our world, everybody's world, and are now, as we say, really in that TPD claim space. The attraction and finality of a lump sum. So there could be some kind of an inclination, or less of an inclination, to go back to work. But I'm really keen to harbour the point here. This isn't overly negative, and we certainly don't think most consumers do that in the main, but that lump sum, particularly those larger lump sums, may incentivize people to stay off work a little bit longer. Overinsurance, especially when combined with other solutions. By other solutions, I think we're mainly talking about disability income cover, but trauma might have a role to play in there as well. Management of occupation. So that's not just around what duties you can perform, but how the occupation landscape has changed over the years, and perhaps we haven't kept up with it. A lot of people are going to, from the time of underwriting to the time of claim, if they ever do need to claim, are going to have changed their occupations throughout that time. When perhaps years ago there was less of that. TPD product evolution is constrained. The product team helpfully suggested some focus areas, is what we're calling them. Support appropriate timeframes for the assessment of permanency, consider policy wordings, legislation and requirements for the life insurance code of practice, for which every member is bound. Where practical, increase the use of objective eligibility criteria and policy wordings. And as before, and as I've said, we acknowledge that objectivity can't always be utilised. Consider alternatives to single lump sum payment structures, particularly for conditions without objective severity measures. So they might be sort of incremental payments as an example of an alternative to that. Where practical, terms of cover within TPD and related benefits may include provision of the financial support, like I just mentioned. Operate on an indemnity basis. So TPD is a very finalised payment. If you take out $1.5 million and you meet the definition of $500,000, you're paid that. And consider approach to benefit indexation relative to CPI and changes to expected financial need over the time. So what we know is that perhaps most people take out their all of their covers, not just TPD covers, at a time they might most need it, but that financial need may alter, it might increase even, but typically it may decrease over time as well. Consider the interaction of TPD with other insurances. I think particularly disability income cover, single product structures that account for both temporary and permanent disablement. I won't go on too much, this is very Australian, but sort of industry body engagement with ASIC and advice dealer groups around application of best interest duty. So what they think we mean by best interest duty, and as always the highest sum insured, the best way to go about it, those sorts of examples, and government and regulators around legislation which may adversely impact customer outcomes and challenge the TPD sustainability. And if I could just sort of say that sustainability is obviously about meeting our customers' needs going forward, remaining profitable, but also keeping premiums down in order that we can be there to meet those needs. So that's what we're talking about when we talk about sustainability. So moving along to underwriting. So talks about what we're responsible for and playing a crucial role. Now, one of the issues was for decades, underwriting philosophies have remained largely the same despite the evolution of medical practices. And underwriters are challenged to do things faster and with less information. These challenges are often presented to underwriting departments by multiple stakeholders, as customers, as financial advisors, internal business departments, internal business development departments. They are obviously wanting to make the journey to insurance, a pathway to insurance, easier, and we absolutely applaud that. But in some cases, it's come with diminishing risk controls for underwriters, and we need to be aware of that and examine that from a multi-stakeholder standpoint when we do that. The underwriting challenges, there's no second chances, so it's guaranteed renewable. We don't get a chance to look at them 2 years, 5 years later, unless they ask us to by way of an increase, and then even then we can't go back and change the base. Occupational trends and definitions, I think that there's some overlap there, and I touched on those earlier in the product section. Financial controls and overlap, again, I think we've already touched on those, but they're pretty prevalent in underwriting as well. And medical implications. I think importantly, we've had exclusion wordings that we think are suitable and fit for purpose, and we think that they might cover sort of comorbidities or secondary conditions, but have those been challenged? Are we looking at them as regularly as we should be to determine that they're doing the job of protecting us against adverse risks like we think we do? Underwriting opportunities, so doing more with less information. We need the checks and balances, ensuring the industry's desire to enhance the customer experience is balanced. Consider reassessing a person's need over time. So that could be a review. I think it's an unpopular suggestion, but it is a suggestion nonetheless. Monitoring occupational trends and managing occupational creep. So that's occupational creep is where someone's a class at underwriting time that they're not at claims time, or trying to get a better premium at underwriting time. We do see that from time to time, and we just need to be across it. How to look at underwriting both disability income and TPD effectively, and ensuring the correct categorization of occupation to ensure that it's been correctly rated. Again, having that underwriting control to try and protect against that occupational creep. onto claims. So the top 5, the changing nature of disabling conditions. I think I've touched on that before, and because we have Carly as part of the presentation, I won't delve too deeply into this section. It's never too late, but it can be too early. So I think again, I'll let Carly talk about that. Financial controls and overlap. That's 3 from 3. So it was called out in 3 sections, and medical implications. And just here, I think it is important to call out and this is well addressed in the paper, is the increasing volume and complexity of TPD claims places significant pressure on claims professionals to work faster, smarter, and harder to ensure the right decisions are made. And this sets against the backdrop of, a post-pandemic environment, economic challenges, IDII sustainability measures. So we had sort of some regulated changes in the Australian market that started to take effect in 2020 and worked beyond that, and concurrent and persistent regulatory change. Focus areas revisit required amendments to understand feasibility of introducing a statute of limitations to clearly outline a reasonable time frame to notify of intention to claim TPD, explore terms of cover with TPD and related benefits. Incremental financial support's been raised again, alternatives to single lump sum based on the condition or the injury or the severity, the relevance and practicality of a more objective assessment, measure of permanent impairment of mental ill conditions, for example, PIRS. TPD content with professional qualification to delve deeper into topics such as evidence weighting for TPD decisions, eligibility assessment, case law and precedents. Clearer occupation definitions, and encourage work participation and retraining, given what we know are the associated health benefits. I'm not going to spend too much time on the medical TPD challenges, and this is because, just for transparency, a group of CMOs came together, and there were only 7 of them. So whereas our membership was otherwise really represented, I probably wasn't as much in the CMO space, but you can see here, has the industry become over-reliant on treating clinicians for TPD insurance, looking for insights, not answers, seek first to understand, then to be understood. A sustainable TPD product likely agrees with clinicians' wish for their patients, which can sometimes be in contrast to how an insurance assessment might be made. Yeah, I'm just kind of going to bring you the summary. I think the areas that we had in common across all of the 4 disciplines represented were addressing the challenges in assessing permanency, addressing the binary nature of the payment, so it's all or nothing, moral hazard given risk, given potential benefit size in the retail channel and sufficiency in the group channel. There's a shared interest across insurers, clinicians and customers in supporting work participation and the return to wellness. The methods of calculating the sum insured and the overlapping of cover provided by long-term income protection products, the need to address that, or the potential need to address that. Consideration of societal changes whereby Australians are more likely now to have multiple careers, and I touched on that on the start. There is an opportunity for new and revised risk solutions to better align with customer needs. It's important to address these issues in order to improve alignment with the principles of insurance. And as I say, we need affordable insurance with predictability and future cost, and accessible for all Australians at cover levels addressing their financial needs. And if I can speak for New Zealand, I do speak in the New Zealand market. Whilst they haven't seen these issues as we have seen them, they're prevalently here, and while we're working on them, I'm pretty sure that New Zealand's sentiments around sustainability and meeting the needs of our customers would be exactly the same. And that's all for me. Hopefully I've left a lot of other time for the other speakers.
Thanks very much, Carmel. Just a couple of little points from me out of that, and it might be any of our speakers may be able to talk to some of these. Obviously in 2020 with the pandemic, our world kind of changed. Where I was working, where I'm working right now in a spare room at home was vastly different to where I was working in 2018 when I was required to be in an office. So has that kind of almost changed, how you would define a disability in terms of people may be able to work now, whereas previously they couldn't due to physical restrictions or requirements?
Yeah, it hasn't changed anything from an underwriting point of view, but Carly, did you want to just touch on that from claims? I mean, has it touched on sort of your assessment at claim time in terms of the ability to be able to continue with your job should you be able to work from home?
Yeah, definitely. I think we saw a few things come around through COVID. So firstly, much more working from home. And so that made getting people back on graduated return to work plans a lot easier if they had a role which could be done from home. So we did see improvements in a lot of return to work plans that were done in a graduated way, which was great. But what we did see on the flip side then is a lot more burnout cases. So people were blurring the lines between work hours and home, and it all just became working long hours, and also the impact of social isolation through the big lockdowns. And particularly in Victoria and Australia, where we're the most locked down city in the world, we have seen a number of sort of social isolation, mental health claims as a result of that. So it kind of went both ways, and it really depended on people's occupations. I think even for a lot of insurers that were still paper-based at the time COVID hit, within 2 weeks they had to get all these scanning people to scan everything electronically and all that sort of thing. So I think depending on the nature of the job that you did at the time of the pandemic, really determine your ability to return to work or stay in work, or even then tip it over to the other side and get into that burnout territory.
And off the back, like you mentioned, and as Carmel mentioned, a rise in mental health claims in relation to TPD as well. So it's probably a bit of a sensitive one, but determining, permanency when it comes to a mental health illness, are there quite a few challenges we're seeing in that area?
Yeah, definitely. So I think that's another big difference between Australia and New Zealand. So TPD is pretty much mental health is the leading cause of claim in Australia. So between 20 and 25% of the new claims we get are primary diagnosis mental health, whereas in New Zealand, that's a lot smaller and your leading cause is still accident and musculoskeletal type claims. But you're absolutely right. I think when we think about the word mental ill health, it's a continuum. So people can be really unwell for a period of time, then they recover and they're well for a period of time, then they can go back to being really unwell. And so saying that condition is permanent and they'll always be operating at that really unwell phase is almost quite dangerous for them as well in their recovery. And it also goes into the territory of putting labels on people and telling someone with depression that they're totally and permanently disabled has quite a negative connotation to their own self-worth and their own ability to recover and function again. So for mental health, it's a really tricky place to be. And it's not like a broken leg with an x-ray where you can see the break on an x-ray. With mental health, a lot of the symptoms are subjective and they can go through that boom and bust and do really well and then sadly crash out and not do so well. So it's really tricky, and I think it, again, depends on the nature of the occupation. And with a lot more retail life policies in Australia being for white-collar professionals, having a mental health condition then makes it really hard to think about return to work options for them.
And I think if I just call out from the New Zealand perspective, I think that's a big danger for us. So as you say, Carly, historically, it has been the more accident, more really objective stuff that we've been paying for. But with the, for want of a better term, normalisation of more subjective conditions, COVID included, the potential is that we're going to see more and more of this. And in regards to whether someone is permanent or not, we have limited medical resources to make those assessments, which is a real big challenge for us, even getting psychiatrists, psychologists, these types of people to do independent assessments, because they are few and far between and so busy working in the public sector for the most part.
Yeah, good points. And people in rural type areas, etc., struggling to get into healthcare, doctors, even making a doctor's appointment obviously is challenging at the moment as well. And that goes across our specialists. And I would assume, particularly in New Zealand, there's not a lot of specialists under or across certain conditions in particular. So even if you're looking for alternative opinions, the pool is probably quite limited. I just in the presentation then we're talking about product development and looking at the way forward as well. There was a comment in there around looking at kind of a severity-based options potentially in future. So ACC in New Zealand, you can get a lump sum payment out for a permanent disablement. I think it's up to 160,000, but it's a scale and it goes up to 80% impairment, I think is the maximum. Is that the kind of thing that potentially the market should consider in terms of some kind of scale? I guess the thing that jumps out in my mind is, again, it would be hard to assess a degree of impairment and reaching agreement on what those thresholds are. I don't know if anyone's got any views on that.
Yeah, look, I mean, they definitely exist in the New Zealand market and people have tried it, severity-based or the bucket approach. The problem is they don't sell as well when compared to, I mean, if we take trauma, for example, they don't sell as well when you compare them to a full trauma product because it's an all or nothing deal, right? And the premium break is not sufficient enough to make it really attractive, nor, I guess, if the advisors are doing the right thing, not appropriate for them to give the advice that this is a better product compared to that if they're doing a direct like for like. I think the other issue is that product development, as it has happened in New Zealand recently, is kind of our little Venn diagram of need versus benefit has kind of changed into a circle. So what we've ended up with is every product's a Rolls-Royce product, and there aren't any Suzuki Swifts, and this is the problem. You know, no, because we're certainly not saying we should stop creating full noise, you know, full benefit policies. We're certainly not saying that at all. I think what we need to look at, though, is investing more in everyman cover, because we're all people, we've all got the same needs. The average New Zealander is changing and has been changing for a long, long time and looks nothing like me now. So the new average New Zealander, the New Zealander who perhaps hasn't had the same exposure to growing their wealth, nor the need for risk protection, needs to come on that journey. So I think what we need to do is look at what products can be developed to support growing the underlying insurance pool, which is the real problem.
Thanks, Scott. And I think one of the notes also there in the presentation was around potential single product structures. So just in terms of my thinking, is this almost some product that accounts for whether it's a temporary or permanent disablement under a single product? Is that right?
Yes, I think it was. But so we've got nothing at the moment that sort of suggests you could be temporarily disabled for a certain amount of time. And one might say, well, you've got DI for that. But not everyone's going to have DI concurrently. So I think, yeah, so I think there was that. I mean, there is a market here for incremental payments on TPD, but it hasn't been copied. So yeah, there is one operational, I should say, not idea thought of and then closed, but at this stage it hasn't been copied. You know, and it seemed to me throughout the months on that paper that everyone, product especially, seemed to think that there was something in that we should, you know, be looking at that far more closely again to sort of meet the needs. Not everyone needs that sort of $500,000 or $3 million or even $5 million up front. You know, unless it's a true catastrophe, like I'd sort of alluded to it, you know, perhaps in the 1960s when you were actually hit by a steam train or something. But
thanks. Scott, I might just turn to you for a moment, and I know we've previously talked about it when we talk about sustainability, and just probably going a little bit wider, though. I think there's probably a wider discussion point in terms of just the overall insurance market, because at the moment the numbers that we're kind of seeing are not exactly growing, and if it is showing some growth, it's generally due to indexation growth rather than true real growth. So I don't know if you got any thoughts on when you kind of tie in sustainability and long term, but the overall market, not just TPD.
Absolutely, and I think it talks to accessibility and affordability for our consumers as well, right? So at the moment, what we've got a stagnant pool of customers here, and there hasn't been any real meaningful growth in the number of lives insured for a while. And what that means is the profitability that we're seeing is benefit addition profitability, year-on-year premium profitability, but in a background of aging policy years, aging insured lives, which has, you know, the potential to have two real catastrophic effects on the industry. One is increased lapse rate, and the second, of course, is deteriorating claims experience. And the people, you know, generally speaking, who hold the policies for the longest time are the people who can afford it, which means they have the biggest covers. So if we don't attract new lives to the pool, eventually it becomes unsustainable. And the reaction by the market, you know, could be we have to stop selling certain product types. In the worst situations, and we don't have to look too far ago, we close the doors to new business and we lose someone from the skyscape, which we don't want, or further consolidation of the industry, which we also don't want. We need to have competition and we need to have consumers, but increased lapse, increased ages, and deteriorating claims experience leads to bigger premium hikes, which has detrimental effect on attracting new lives into the pool. And this is a big challenge for the industry as a whole, I believe.
And it probably doesn't help when there's a tough economic climate going on as well in terms of new business. Probably last on a lot of people's mind is insurance when you're struggling to put food on the table or pay the mortgage.
And those of us who read the paper recently would have seen that very sad case of that person who said, I'm a healthy young person, I don't need this cover anymore, I'm cancelling it due to affordability. Boom, there's a diagnosis, and I'm pleased to say that the industry is trying to look after that person, which I think is great.
Yeah, that's good. Just a question that's come through the Q&A. It's probably might be heading Carly's way, this one. Do we know what percentage of TPD claims in New Zealand relate to mental disorders? Because in Australia it's now between 25 to 30%, but do we know the numbers of mental health in TPD in New Zealand?
I'm just talking roughly on our reinsured book, and I think it sits sort of in the single digits, sort of around 7 to 9%. And that's primary diagnosis mental health. Obviously, we see quite a few where it's a physical injury and then there's a secondary mental health claim, but it comes in as a physical injury first. But interestingly, there's probably more cancer and neurological TPD claims in New Zealand. And that goes to Scott's point around the average age of the policyholder. I think because Australia's got compulsory group insurance, obviously, if we look at that, there's lots more people in their 20s and 30s to grow the pool. Whereas in New Zealand, the average age of the policyholder is usually anywhere between 45 and 55. So they're getting into that territory where they're more likely to be diagnosed with cancer or suffer a neurological or cardiac condition, which then would deem them TPD. But luckily, and I'm touching everything wood here, that mental health isn't a leading cause, because it is a really challenging condition to try and manage. But obviously there's opportunities to be able to support customers with treatment and things like that in New Zealand as well. So again, how do we make the products more customer centric and give them the support that they need so they don't become TPD? Ideally, we give that to them through their IP claim or trauma or where have you, so they don't get to that stage.
So, and a couple of points have probably already been covered off, but so there's definitely far less workplace accidents that we see these days, I assume, and I guess that's a combination of the way perhaps people are working, but also that workplace health and safety, etc., is improved over time, and also, so it's also true that there's that shift to more white collar versus blue collar within that TPD pool. Is that right?
Yeah, and lots of self-employed people as well in the TPD bucket. So they may not have, or in Australia, they would prefer to claim on their TPD or IP policy rather than on workers' compensation, for example, because obviously we know in Australia roughly every dollar that you spend on a claim in workers' comp is $4 in premium. So it costs a lot of money to have a self-insured claim go through workers' comp, whereas if they can claim on their life policy, it's financially a better option for them.
There are a couple of points there made around kind of the detrimental, I suppose, feeling around labelling an illness as permanent and how that can actually kind of counter, for people's well-being. It's probably better to get people back to work overall, but they would probably look at a lump sum payment and want to pursue that in the short term. I don't know, is there much we can actually do in that space? Is it around rehabilitation in conjunction with diagnosis, or?
Yeah, I mean, Carmel touched on that installment design product in the Australian market, and that is really based on that. It's hard to change the name of the product, otherwise it causes all sorts of confusion for people to buy it and sell it and what have you. But this installment design is to say that we don't think you're totally and permanently disabled right at this point, but how can we support you through giving you installments, payment installments and rehabilitation support to try and help them get to the point where they can return to work rather than having to go through 5 or 6 assessments of their disability and how that impacts their function. So it really is to try and get people the right support early, especially if they only have TPD. They might not have the luxury of having salary continuance or income protection. So these products are designed then to try and funnel them into rehab support early, because I think we know that the longer someone's out of work, the less likely that they are to go back to work. And the key is obviously being employed in good work, but with so many mental health conditions, we know that people being employed and engaged in good work is actually good for their health, and it's a sense of identity, it's financial, it's that well-being of being in a great workplace, that it's actually good for people's well-being to be in good work. So those are the reasons that we try and promote the positive parts of TPD insurance, and giving people that opportunity to try and get well and how we can support them, rather than just saying you're totally disabled for life and here's your payment, because there's lots of research around the detrimental effects of doing that as well, lump sum payments. Gambling, we've had like instances in Australia where someone's partner's called up saying, please don't pay my other half this money because he's just going to go straight to the casino and lose it all, and our mortgage and things. So there's so many moral hazards around it that we just have to be really careful, and the focus should be on helping people get well again and helping them return to function and hopefully work if they can.
Looking in the Q&A, there's a good comment here, and it's off similar to what Scott was actually mentioning, which was New Zealand advisors are terrified of recommending anything other than a Rolls-Royce product, with all the bells and whistles, and that trauma and TPD come to mind, and the need is for less expensive products that probably focus on the key benefits. But I guess we face with a also, first mover kind of disadvantage, or they don't sell that well, has been another theme that would come through. So it almost probably needs an industry approach, as opposed to a singular organisation. Would agree with that?
Yeah, I think the opportunity is to look at targeting the clients better and segmenting them better and developing policies for those segments. The direct space in New Zealand presents a massive opportunity. That banker channel represents a massive opportunity, especially now that it sits with the insurance experts as the distributors of product. So I think the opportunity is to develop different distribution methods that will talk to some of these people who perhaps don't need or would otherwise not seek out full advice. And we're certainly not saying that full advice is not important. It's absolutely important, especially for a certain segment of the population. We're saying that everyone else has needs as well, and how can we fill those gaps? Propensity to claim models, propensity to buy models, some of those other awakening the need type tools, I think, are where we need to develop. And I think I don't know if any of the rating house guys are on the line, but I think there's an opportunity there as well. How is the market segmented, and how are recommendations made? And how can we better align need with some of the ratings potentially? I think there's lots for us to consider, and there's lots of things we can work on. AI is developing, so we can free up people to do more important stuff. We certainly don't want to run into the same problems that Australia had with the Royal Commission, where we get a whole bunch of, that's just junk insurance, that's not worth anything. So whatever we develop has to be fulfilling the need, which is the starting point of any product development journey, right?
Thanks, Scott. Another question come through here. If income cover is meant to replace lost income, what do you see as the key purpose of TPD, apart from accessibility changes to homes, cars, careers, etc., or carers, sorry? Or do you think customers are using it as an income replacement, as it's generally less expensive than an income protection cover?
Look, I think that there is a very real need for it. I mean, we see it all the time, and Carmel will jump in. We see it buy-sell agreements, especially for the big organisations where partners of some law firms and accountancy firms are absolutely key to driving the success of those businesses. If they can't perform, then the buy-sell agreements come into play. So absolutely, there's a need that goes over and above purely replacing income. I think it's dangerous to sell it or buy it as a direct replacement for income replacement, because the threshold is unapologetically much higher, as it should be, in my opinion. So I think it has been a strategy for some people, but obviously would caution against anyone employing such a strategy. I think there are other better mechanisms for income replacement, that's for sure.
I think, if I might add, it has a place. I think when you're putting it with something like disability income, now, if you do have a catastrophic accident, you need house modifications and all of those kind of things, your DI sort of 70% replacement ratio isn't really going to help with that in the short term, unless you're kind of getting some kind of government assistance. There's trauma, but trauma is very expensive. A lot of people are priced out of trauma or don't have enough trauma. So there are some real needs there in the catastrophic sense. And then I think so I'd say, yes, maybe it's being a little used for a DI, so as a DI supplement, but as Scott says, the thresholds are much higher. In most cases, you shouldn't be seeing that. So it does have a place alongside DI, and well, first of all, it has a place. It does have a place alongside other benefits, whether it's personal or for business purposes. It's just that we're seeing, but what this thought paper is sort of meant. Ideas it's meant to sort of suggest is no one's really thinking about the interaction, and where we might suggest that an interaction is so if they're going for the absolute maximum of TPD and the absolute maximum of DI, and they're both payable to the same household versus a business and then a personal household, then what's the need for that cover? And just as well, I think Australian advisors are similar. We've got the best interest duty, the most generous products, the highest sums assured, those sorts of things, and as an underwriter and as an underwriting group, we'll often be asked, but why did you give them that much? Well, frankly, under the definitions and under the product rules, they satisfy that they can have that much. Until the product rules change, underwriters can't really do much, and we cannot give advice. So yeah, there's lots of things to consider there, and I think there's no black and white answer to that question. It all has a place, I think.
Looking at the New Zealand markets, so when we look at the stats, TPD actually sits quite low, you could say. So obviously the focus on life, IP, and trauma, and then it's the next one down, taking health out of the picture, is TPD, but we're kind of looking at less than 5% probably of the API coming through on that. And there might be probably even a larger proportion in group versus retail. But is it actually undersold in New Zealand, do we think, TPD? Any thoughts on that?
Yeah, it's hard to say if it's undersold. I think we have a population that kind of has moved away from farming and industry as a way to kind of earn a living. So we've got lots of white collar workers, lots of people who perhaps don't have a need for TPD. So I don't know that it's undersold, but if your mortality risk is first cab off your rank, then your DI is next to protect your income. I guess if you're looking at your premium dollars and what they can buy, I guess that's where the decision-making point comes in. So I don't think it's undersold. I think that it's there to be used for the right situations.
Just looking at some more questions coming through. Does the existing TPD product suffer from cross purposes? Could a different structure be more appropriate? Don't know if I'm quite sure what we mean by cross purposes there.
I guess if we look at the involvement of the other products, so TPD is probably the single product that's had the least enhancement work in my time in reinsurance anyway. So the last big change to TPD in New Zealand was the change to qualifying periods, 6 months to 3 months. Beyond that, it's pretty much as it was originally kind of designed. But the other policy types have all evolved. Trauma, for example, now covers everything, including ADLs, TPD type scenarios as well, as do some DIs. Even mortality is morphed into a quasi-trauma when there's 4 or 5 conditions that are life-limiting, but not within the 12 or 24-month definition. So even, you know, the Are You Dead, Are You Alive policy has morphed into something more. So I think that there's, you know, there are other options out there, right?
Another question here. And I'm not sure whether we will have these numbers, but what is the claims ratio of TPD products in New Zealand compared to life and trauma claims? But I don't think I have those numbers in front of me. I don't know if anyone off the top of their head have any of those statistics. No, sorry about that. We can't answer that one at the moment.
I guess that's a positive too in one respect. It's not keeping anyone's actuarial team awake at night. So it probably doesn't hit the headline.
Another point here is do you think customers understand that there is such a high threshold for TPD versus IP? My view on that is potentially not, but hopefully I think it's an area maybe where advisors you want to keep on top of, and yeah, ensuring that your customer understands that. But yeah, there is quite a different threshold in play there, and I think it's probably critical that people understand where that is, where those thresholds lie.
Yeah, and I think for fully advised products, they probably have a better understanding. Many years ago, I assessed the group TPD claims for AMP, and I would see employer statements come through going, well, we gave them the option to you know, take some money as a medical retirement or claim for his TPD, and he wanted to claim for his TPD. So I think in the group space, historically, there may have been a little bit less understanding, but you know, definitely the advice in that channel has gotten much stronger in recent times.
I was just going to loop back into the Aluka paper, which Carmel looked at the start, and I think what we do see is definitely a change in notification patterns, and some of the reason why the Australian experience has gone so poorly is because the IBNR was looking at sort of emerging experience between 3 and 5 years of TPD. Now we're looking at up to 10 years of a notification lag, and obviously that throws pricing and everything else out when we don't get the IBNR right. But it also works at the other end as well, because there's no statute of limitations for how long it can take you to notify a TPD claim, but it can also be too early, which is what the Aluka group found as well. So we have people just submitting a whole lot of medical information. They may have a concurrent IP claim, but they're not deemed permanent yet. So we have to go through the channels of writing to them, procedural fairness, all that sort of thing, and then get them to come back when they've undergone further treatment and things. So I think as Scott mentioned, as well as the advisors become more informed about what is required to make a claim, we see improvements in the claims management and claims assessment timeframes. In Australia, obviously, we have life code of practice, so we have to assess things within certain timeframes, but when the condition's not permanent yet, that becomes really complicated. We have lawyers and we've got Akker making decisions, and the world of the claims assessor becomes really, really challenging. So I think there's lots of work that we can do as an insurance industry around educating the public about TPD or different types of insurance and when you can and can't make a claim, as well as the advisors. But I think the more that we can advise people in the right way, the better a chance we have at making the right claims decisions at the right time.
And that's a key point too, Carly, and one of the major differences, and one that we need to probably keep a close eye on in the background of potential changes to regulation here, timeframes to decision making. You know, absolutely, we've always been aware that we had to be timely, but it's never been a dictated parameter. So I think there could be some challenges on the horizon if we go down that pathway.
Just another question come through, and I'm just mindful of time at the moment, but do we think insurers will walk away from the group TPD space since it has a higher claims ratio than retail products due to no underwriting? But I would assume that the group space is priced to allow for that, and there's nothing jumping out as causing major sustainability concerns there.
Are we specifically talking about New Zealand? If we're specifically talking about New Zealand, then I don't believe so. No, I think it's a staple of the offering, really.
Yep. Cool. I do apologize if I didn't address a question there. Just looking at the time at the moment, I just want to take a couple of minutes as well. We might just do the rounds just one more time with our speakers. And I guess looking at the Aluka report and the investigation and looking at it from underwriting claims product perspective, I just wonder if I can ask each of the speakers just to maybe call out a key takeaway, I suppose, for the New Zealand industry to consider. Carly, do you think we could start with you?
Sure, yeah. So I think my biggest takeout from a lot of work last year and into this year is having now the opportunity to look at how we can make the product more customer centric and fit for purpose for the future. So we talked about occupations changing, we talked about the nature of conditions changing, cost of living pressures and affordability. So I think we have a real opportunity soon. We haven't really done too much to TPD in Australia or New Zealand for many, many years. A real opportunity now to say what is going to best serve customers into the future, to make sure that we don't make the underinsurance gap widen, but actually give them the right protection and the right support as early as we can.
Thanks, Carly. Scott, any thoughts?
Yeah, look, I obviously echo everything Carly said, and I think if I step back and take a macro view of what we're saying is that, you know, people have needs for insurance. They aren't always understood as well as they should be. And I think we're going to do lots of work to try and address that in the short, medium term. But if you take a long-term view, and if you take a generational view, actually we've got to take a good hard look at the governments and go, there's a big gap in our education system. We are not teaching kids about, you know, wealth and risk protection. And, you know, they start working and they've got no idea what they need to do. So I think a lot of the issues we have is stemmed from a lack of education. And I think that's where we should be focusing. But that's generational. That's 20 years. If we started today, that's 20 years away.
Yeah. I think financial literacy, yeah, across the board, whether it's insurance, whether it's banking, mortgages, debt, etc., is a pretty big one, KiwiSaver, as well. So yeah, that's an aspirational vision you have there, Scott.
Yeah, we go big at RGM.
Carmel, final thoughts?
Yeah, I think a lot of it's already been said. I do think the product needs some rethinking around TPD. I do quite like the idea of incremental payments, or I do like the idea that it's not just a one size fits all proposition, and that one lump sum for everyone, and that's final, and that's all it does, when it could be so many things. And again, those customer needs aren't all going to be the same either. So we need to ensure that we're meeting those customer needs in unique ways that changes along with the landscape. When you consider how global our economy has become, and people doing 2 years overseas these days to work in their careers and further their sort of career opportunities and understanding, only to return to where they come home, and how we can make sure that they're insured during that time of their life as well. The other thing I just think about a little bit, and it's not really addressed in the paper because it's not a current burning issue, but we often talk about the issues of today being the customers of today, but the cohort that's going to come through are the young people now. And actually, we should be reading about their experiences and things now. So there was a report that came out about 6 weeks ago, a global mental health report that talked about sort of generational changes and mental health and mental health awareness and wellness. It even had some really immature but alarming and interesting studies at the same time around the younger you're exposed to smartphones, perhaps the more likely you are to suffer from X, Y, and Z. So I think honing in on what trends we need to look out for now to ensure that we can insure the customer of tomorrow as well is just as important as the challenges of today.
Great. Very good points, Carmel. Thank you. Right. Now, just before I will hand back to Rochelle, I just want to thank all our speakers for coming along today and giving your valuable time and insights for us to all take away and consider. So that is very much appreciated. And Rochelle, in closing, I'll just hand back to you.
Thanks, Shaun, and thanks for the panel for today's webinar. Certainly an engaging topic, and lots of really good discussions and questions coming through. Our next webinar is on the 18th of June, and it's our engagement in the financial services industry. And we really hope that you can join us for that webinar. We also have an in-person event in Auckland just coming up on the 12th of June, and that is New Zealand and climate change. Where are we now? We have the Minister, Honourable Simon Watts, joining us, and a panel discussion that will follow that breakfast. So we hope that you can join us for that. And of course, our big conference that we run every September, FSC 24. This year, the theme is Consumer Resilience and Prosperity. Pop onto our website. You can see the almost 80 speakers that are going over those 2.5 days. We really hope that you can join us for that. And the early bird ticket sales finish in just 2 weeks' time. So now's a great time to register and save a little bit of money and get involved into our annual conference, which is the highlight of the sectors coming together. So we're really excited to see everyone at that conference. But thank you today, and we hope that you enjoyed it. And we look forward to seeing you again at our next webinar. Thanks, everyone.